The fear factor is now driving the gold price higher, which actually is not so much gold going up, but it's more the dollar going down. We have had a massive breakout on the upside for the gold price, rather signaling that the dollar's trade weighted will fall from around about 101 at the moment, probably through the 100, and then the next stop is around about 90. This is a very major move down. I think they've weakened too much. Silver has really caught a bid. That's been rushing up and has got a long way to go. I mean, looking at the moment, the gold-silver ratio is 84. It was 85.5 this morning. That should fall, I think, towards 70 and below, which tells me that silver is going to be a lot more powerful in its up move than gold.
The recent rise in gold prices is driven more by the weakening of the dollar than an actual surge in gold value. The US dollar's trade-weighted index, currently around 101, is expected to drop below 100, with a potential fall to 90. This is a significant shift in the currency market. Meanwhile, silver has seen a strong uptick, with the gold-silver ratio at 84, down from 85.5 earlier. This ratio is expected to drop towards 70, indicating that silver may outpace gold in its upward movement, though it's currently being driven by gold's momentum. Alasdair Macleod is a well-known economist, financial analyst, and advocate for sound money, particularly gold. He explains that foreign investors are selling off the dollar, which is weakening its value. A weaker dollar might require higher interest rates to stabilize, though some economists might welcome a slight decline to support the economy. However, experienced investors like Warren Buffett see increased risks in the banking sector, potentially more than share prices reflect. Higher interest rates could expose bad debts, especially from companies that borrowed when rates were low. This is a global issue, not just in the US, and could lead to banks needing rescues. This may explain why Buffett is reducing his Bank of America holdings. While major banks are unlikely to go bust due to government intervention, the real risk for depositors lies in the weakening value of the dollar. Even if deposits are guaranteed, losses could come from the dollar's declining purchasing power. Past bank crises were resolved without depositors losing funds, but the system was stabilized at the expense of the dollar. Depositors should consider whether they want their savings held in dollars, which are themselves a form of credit, rather than worrying about the bank's immediate stability. Let's dive into the video for more insights. If you enjoy the content, don't forget to give us a thumbs up and subscribe to our channel for the latest updates.
The foreigners are basically selling down the dollar, which will weaken the dollar. And if you look at what the dollar is doing, you can see that a weaker dollar is going to require higher interest rates to stabilize it. While, a little bit of a drop in the dollar you can tolerate and all the rest of it. And, the Keynesians would probably welcome a little drop in the dollar because it might support the economy. Ha ha. But you can see that there are a number of reasons why an assessment by a really experienced investor such as Warren Buffett might suggest that there's a lot of risk in the banking sector, more risk than the share prices would indicate. So on that basis, I can understand why he would reduce his holdings. The problem with interest rates, as far as the banks are concerned, is that it would, I think it would reveal a huge, great quantity of bad debts. I mean, you've got all these zombie companies who have borrowed cheap finance when you had rates at the zero bound. And now, of course, they can't afford to refinance their position. It's just, they really are in an appalling position. And it's not just in America, this is all around the world. But the problem really is enormous for the banks because there are going to be huge, great problems. The banks presumably will require some sort of rescue if this really does deteriorate. And on that basis, do you really want to have all your eggs invested in a bank? I don't think you do. So I can understand why he's perhaps, it could be the reason that he's loosening up on his Bank of America holdings. I mean, I would certainly be reducing my position. The one thing I would say is that the idea that the Fed and the US Treasury would allow banks to go bust, and particularly major banks, is extremely unlikely. They will replace contracting bank credit by expanding government credit. So what happens is that your deposit in the bank may well be guaranteed. And I'm not talking about, if the bank goes bust, there's, you get bailed out by, sort of a massive joint fund. The problem, I think, is that your losses are going to be in the dollar rather than on bank credit being if you like, expiring, being not honoured. So that's the way I'd look at it. Banks will be rescued. I mean, we saw this when we had a number of small regional banks a bit over a year ago. There were no deposits lost. I mean, basically, the whole thing was engineered in such a way that they were taken over. The Fed stopped the run, if you like, on valuations by saying we will permit banks to value, their bonds at sort of full value, whatever they came up with means, if you like, to stabilize the system. They'll continue to do that, but it will be at the expense of the dollar. So that, I think, is really what depositors should be considering. Do they actually want dollars? Do they want deposits in dollars? Do they want credit measured in dollars? And dollars themselves are credit.
Alasdair Macleod also highlights that central banks and Asian buyers, particularly the Chinese, are driving gold demand. Chinese consumers, with a high savings rate of around 35%, are shifting money from property and stocks into bank deposits and gold as deposit rates fall. Some of this is being directed into gold accounts at banks, which are then buying up available bullion in London. This has created a strain in the paper gold markets, contributing to the current market dynamics. Although the COMEX has about 530,000 contracts, with the largest short positions held by swaps. These positions are being squeezed, and if forced to buy back in a rising gold market, it could accelerate gold prices rapidly. The main driver behind this is a loss of faith in fiat currencies, especially the dollar. The dollar's trade-weighted index recently formed a death cross, a highly bearish technical signal indicating further weakness. There's a growing sense of crisis in the markets, highlighted by Warren Buffett's cautious stance. Inflation suggests interest rates should rise, but the U.S. economy is underperforming. The August budget deficit hit $380 billion, double the level seen during the COVID crisis, signaling a severe economic slowdown. Similarly, the Chinese economy has also slowed significantly, particularly in production, indicating both economies have hit a wall. Alasdair Macleod suggests the concept of a gold standard is simpler than often portrayed. A currency should be freely exchangeable for gold, either as cash or bank deposits, at the central bank. Gold reserves are managed through interest rates, not to influence the economy, but to maintain confidence in the currency. Let's get back to the interview.
The central banks are buying and the Asians are buying, and they're clearing out the market. Of particular importance is the Chinese consumer, who has a savings rate of roughly 35% of his income. That is huge. It's around about $6 trillion. The question is, where does that go? It's not going into property. It's not going into stocks. It's going into bank deposits. The rate on bank deposits is being reduced recently, so some of that on the margin is going into gold, and it's going into gold accounts at the banks. And it's the banks that are coming into London and effectively taking any loose bullion they can get their hands on. And so this has created something of a crisis within the paper markets, which we're seeing today. I mean, roughly the contracts on COMEX, you've got around about 530,000 contracts. The swaps are the largest portion on the short side by a long chalk, and consequently, they are being squeezed. And I would not be surprised to find that they turn tail and are forced to buy back those contracts in a rising market for gold prices, which could actually accelerate the price of gold very, very rapidly. But other than that, really, the thing that's driving it is principally loss of faith in fiat currencies, and particularly the dollar. If you look at the trade-weighted index for the dollar, that's got what the technical analysts call a death cross, which basically is a very, very bearish sign. We had the death cross a week or two ago. So the whole thing has got a developing air of crisis in the markets, I think. And I would go back to what I was saying about Warren Buffett's position. I mean, if you look at the inflation outlook, interest should not fall. They should actually be rising. But the problem is that the underlying economy, US economy, is not performing well. And I don't know whether you noticed this. I think it was yesterday, the budget deficit for August was released, and that was about $380 billion, about twice the level which it was during the COVID crisis, when, there was no income coming into the government and accelerated payments out. I mean, this is a very nasty shock. And it tells me that the US economy has run into a brick wall. And by way of confirmation, we have also had information this week about the Chinese economy, which tells us that has slowed very rapidly. And on the production side, that again has run into a brick wall. Really don't understand credit. They don't understand the relationship between money and credit. They have recommended a backing of 40% gold and 60% currencies, which are valued on a day-to-day basis in terms of gold, and the whole thing put on some sort of blockchain. There is this tendency, I think, to overcomplicate really what essentially is a very, very simple relationship. The way a gold standard works is really extremely simple. A currency must be freely exchangeable, either in terms of cash or in terms of bank deposits for gold at the central bank. It's actually as simple as that. And it's easy to put in too. And it's easy. We do know how to manage gold reserves. You do that by using the interest rate to manage the gold reserves. You do not use interest rates to try and manage economic outcomes. That is a huge, great mistake. As we've seen, time and time again, interest rate policy has achieved absolutely nothing. If anything, it's probably made things worse. So it's all about having sufficient gold reserves in the background to give confidence to people that they don't need to cash in their dollars or rubles or whatever it might be for gold. And that is maintained by the issue department actually having control over interest rates. There are various other aspects of this, but they are relatively simple. And I wrote a paper on this for my Substack readers, which came out yesterday. Yes, yesterday. So I think that the whole of this trade settlement currency thing has been blown up unnecessarily.
The weakening of the US dollar and global economic slowdown are driving investors toward gold, while silver also shows potential for outpacing gold's gains. The critical challenge lies in managing fiat currency risks and reconsidering the role of gold as a stabilizing asset. How might a further decline in the US dollar impact global financial markets? What are the implications of a rising gold-silver ratio for investors in precious metals? Share your thoughts in the comments below. We'd love to hear from you. If you found this video useful, don't forget to give it a thumbs up and subscribe for more content. Thanks for being a part of our journey.